This conference will now be recorded.
Hello and welcome. Today's topic, we're going to cover annuities. A lot of people don't know a lot about annuities. For some people, they probably never even heard of them, but it's on your exam. And with this license, if you're going for your life only or your life accident and health or disability license, you have the capabilities of offering it if you're with a company that's sponsoring you and giving you products to sell. So let's kind of talk about what it really is. Most people think it's a complicated financial product, but in reality, to keep it simple, it's just a savings account with an insurance company instead of a bank. When you set up a savings account with a bank, you deposit money in, and maybe every month you put some money into this account, and every year you're going to earn interest on it. And at the end of the year, you're going to get a 1099. You got to pay taxes on that interest. So by going to an annuity and putting your money into an annuity, just like a savings account at a bank, you're just depositing money in, letting it grow. It earns interest as it grows. But with annuities, you don't get a 1099 every year. The money that you pay in and the earnings it gets or earns grows on a tax deferred basis. And so you have interest compounding on interest until a later date, such as retirement, where you're going to take it out in payments to supplement your retirement. So they're not designed to pay lump sum. It's not a short-term savings account. It's more of a long-term savings account where you're setting money aside to kind of supplement your retirement. Take money out in payments, along with any other programs that you may have for retirement income. So it's just classified as a non-qualified program because not everybody has one. All right. So qualified programs, when you hear that on your exam, think of your retirement programs like a 401k, you know, 403b, which is like a 401k for a nonprofit company, individual retirement accounts or IRAs and things like that. Okay. And so this kind of doesn't fall into that category. It's kind of like life insurance, typically not tax deductible premium, more of a capital investment for yourself. The difference between life insurance and annuities, there's a couple of them, but the first one is life insurance is designed to pay a lump sum. When the insured dies, there's a lump sum of money available right at the time that is needed to cover those final burial expenses or final expenses at that time and provide income for your surviving family members in most cases. Annuities are not designed to pay a lump sum. Annuities, well, they're designed to make payments. So you have this lump sum of money at retirement, and then you annuitize it. That means you stop paying in, you start taking money out, and you're going to take it in payments. So when you take money out in payments, the gains are taxable. And it's going to be spread out over the payment period. So we're going to go into that in a little more detail here. So simply put, the periods of time in putting an annuity in place, you have the accumulation period where you're paying money in. It's growing on a tax deferred basis, so you put money aside. You don't get a 1099 every year. And then later on, such as later date like retirement, you decide, I'm going to start taking money out. And this is what we call annuitization or annuitizing the contract. It's where you stop paying in and now you're going to start taking money out in payments. And so when you're taking the money out in payments, that's called the annuity period. It's the payout phase. So that's simply put, you're just saving up money for a lump to accumulate a lump sum to a later date like retirement, and then you're going to liquidate it by taking payments to supplement your retirement. Not in all cases, but in general, that's kind of how you want to understand it. You got to know the parties to the contract. The owner is the one setting up the contract. Usually they're the applicant, right? They're filling out the application. They're the one paying the premium, and they make decisions on, who's who in this contract. The annuitant is the person who's going to be receiving the money when the contract is annuitized. And they'll receive payments for either a set period of time or possibly for the rest of their lives. During the accumulation period, the growth period, you definitely want to name a beneficiary in case something happens. When you annuitize, that means remember you stop paying in, you start taking money out, there may or may not be a beneficiary. It depends on the payout option that you've chosen. We'll get into that in just a little bit. But get to know who the parties of the contract are. Another thing you need to know is the owner controls the contract. So when the owner dies, the beneficiary gets paid the funds. So you got to watch out because you have first party ownership situations and third party ownership situations. So let's go with the first party ownership situation. The owner is John Doe, and John Doe is also going to name himself as the annuitant. So John Doe set up an account, putting money in, and at a later date, John Doe will annuitize and start receiving payments. If anything happens to John Doe, then there's a beneficiary, and so that would be Jane Doe. So during the accumulation period, if John Doe dies, the money will go to the beneficiary, in this case, Jane Doe. Now, for third-party ownership, that's always when someone other than the insured, or in this case, the annuitant, owns a contract. So John Doe is the owner. Jane Doe is going to be the annuitant. So John Doe is paying money into this account, and then at a later date, like retirement, when they annuitize, Jane Doe is the one that will receive payments. And they have a beneficiary, Jill Doe, let's say one of the children. Okay. So remember though, when the owner dies, the beneficiary gets the money. So during the accumulation period, when John Doe is paying money in, if John Doe dies, Jane Doe doesn't get it. The money will go to the beneficiary, which is Jill Doe, which means if it's a traditional marriage where John and Jane are married, John's the owner, Jane's the annuitant. John dies, actually Jill will get the money, and Jane doesn't get anything. Okay, so you've got to be wary of that. I don't think you'll get much of this on the test. You will deal with it in the real world when you're selling annuities, and you have different parties associated with a contract. So be advised that you got to look out for this situation. If they really wanted the annuitant, Jane Doe, to receive the funds, then they'd have to change that up. Okay. So how you pay for an annuity? You can single premium buy it. You have a lump sum of money sitting around somewhere. Just scoop it all up and single premium purchase this thing. There's a minimum that most companies will need in order for you to start the annuity, but there's no maximum. Some companies may have some maximums, but for the exam, there is no maximum. The insurance company just has to make sure it's legitimate money, that you're not laundering cash through the insurance company. Okay. If you don't have a lump sum of money sitting around, start a flexible payment program. This is a flexible premium annuity. Okay. Where you make a payment just like a savings account in a bank. Sometimes you have money, you put money in, sometimes you don't. Okay. Here and there, you get a bonus at work, you get a little extra in your tax refund at the end of the year, then you can put additional money into this account. Okay. So that's not a problem. So it's flexible payment. So when you want to take money out, well, if you single premium buy this, you bought it with a lump sum, you can immediately, within the first year, start taking payments out. Now remember, they're typically designed for retirement, so we'll touch base. If you dip in too soon, sometimes there may be a penalty there. Okay, but again, maybe you're at retirement age. You got a lump sum of money as far as a bailout from your company that you work for, and so you can just single premium purchase this annuity, and then annuitize it within that first year and start taking payments. Right? By the way, when you hear immediate, it means within the first year you're taking money out. But when you single premium buy this, if you want quarterly payments, when you single premium purchases, you have to wait 1 quarter before we cut you the first check. Okay, so you can't just make a deposit right now and take a payment right now. You got to take a payment after one payment period. Okay, that's kind of how that works. But you could single premium lump sum purchase this now and just let the money grow to a later date, like retirement, typically after 59 and a half. Then you start taking payments. If you have an annuity and you dip in before 59 and a half, well, this is kind of like your qualified programs. You're going to pay taxes on the gains, and there's also a 10% federal penalty for early withdrawal. When you do buy an annuity, like whether you single premium or do a flexible payment program and let the money grow, every annuity has to have something called an annuity starting date. That means if you don't decide to annuitize this contract, the insurance company will automatically annuitize it for you. So they set a date. Usually it's around age 85 or 90. That if you did not annuitize before that date, or that age, I should say, they'll automatically annuitize it and start making payments to you. Okay? So real quick summary, you can do a single premium immediate annuity. Sometimes you hear them called SPIAs out in the industry. You could do a single premium deferred annuity where you lump sum buy this thing and you postpone or delay when you want to take the money out to like a later date, like retirement. We call them spiders. Right? And then you have a flexible premium deferred annuity. I mean, if you're going to make periodic payments, you got to build up an estate before you can annuitize and start liquidating it. And so the flexible payment is always going to be deferred. And by the way, for the test, there's no such thing as a flexible premium immediate annuity. All right, remember, you got to build up an estate and then start taking payments later on. So a flexible payment, you can't make a $50 payment today and say, hey, I want to annuitize this contract, make me payments so it lasts me 20 years. Well, $50 isn't going to last long. So yeah, you got to build up an estate before you can turn around and liquidate it. Now, when you take payments at the time of annuitization, they're called annuity settlement options. And folks, this is really similar to life insurance settlement options. So life insurance is designed to pay lump sum, but if you did not want to leave lump sum to your beneficiary, because maybe you don't trust them, you want to limit what they get by leaving payments. Okay, and there's different life insurance settlement options. Well, with annuities, you've accumulated a lump sum, and how would you like to pay it? Or how would you like to take it? It's either taking it out for yourself to supplement your retirement. And so the annuity settlement options are just like life insurance settlement options. You can take the money out over a fixed period of time, let's say 20 years. Sometimes that's called a period certain, where we pay you for 20 years or until you die, okay, whichever occurs last. Okay, I should say, I'm sorry, we pay you payments until you die or to the end of the period. So if you died within the period, we'll pay a beneficiary to the end of the period. All right. I apologize for that. We can pay a fixed amount. You know, maybe you want $3 grand a quarter until the money runs out. Okay, so we pay you $3 grand a quarter till the money runs out. And if you died too soon, well, then you name a beneficiary, and they'll get the $3,000 a month until the money runs out. Okay, and so yeah, so we're going to make a set payment until principal and interest are exhausted. That's called fixed amount, or sometimes it's called amount certain. Now, with those first two options, you could actually outlive the money. So if you chose a fixed period of 20 years, in 20 years, all the money's been paid out. So that means if you live past that, there's no more money come from the annuity. And with an amount certain, if you're taking like $3 grand a quarter, there's not enough money in the account, you could outlive that money and be left with nothing. And so where we can flip the switch is changing it over to life income, sometimes called life only and sometimes called straight life. And this is where when you annuitize a contract, we pay the annuitant for as long as they live. And so we're going to use mortality tables reflecting a longer life for the annuitant. So you're the only factor. If you're the annuitant and you chose life income, when you annuitize this contract, we're going to pay you for as long as you live. If you live forever, this will continuously pay you forever. How's that? You cannot outlive this money. So this option actually has the potential to pay the most. But the other side of the coin is you got to understand this is guaranteed to pay the least. See, if you die after one payment with a straight life or life only option, all benefits end. There is no beneficiary. You're the only factors. We pay you for as long as you live. So if you died after one payment, the insurance company keeps the rest. You see, with fixed period and fixed amount, if you died after one payment, we pay someone to the end of the period, or we pay someone till all the money's been paid out, but not with life income. All right. So if you don't like that, well, you got some other options. Why don't we kind of blend it? Why don't we go life income with period certain? Why don't I pay you for as long as you live, or to a set period of time, whichever occurs last? So a life income with 20-year period certain, I'm going to make you payments for at least 20 years or until you die. So if you die within the 20 years, your beneficiary gets the money till the end of the 20 years. But if you die after the 20 years, we pay you up until you die. Right? So now, given the same amount in an annuity, life income is actually going to give you a higher payout versus the life income with period certain. The more factors in determining the payout, the less you're going to get. See, life income, you die after one payment, the insurance company keeps the rest. Life income with period certain, you die after one payment, we still got to pay someone till the end of the period. You see, so keeping that in mind, the payments will be lower. Another variation is life income with amount certain. Right, we pay you till a certain amount has been paid out, or for as long as you live, whichever occurs last. Some companies offer a refund annuity. So you annuitize a contract, we'll pay you until, well, for as long as you live, or till you at least got what you paid in back out. Okay, that's how that one works. And by the way, if you die during the payout phase without getting all of your money back out yet, when you die, we can pay it either as a lump sum or continued payments that you've been taking to your beneficiary. Whenever you see joint, think of married couples. Joint and survivor, we're going to pay to two people. So whatever the payment is, we calculate. If it's to two people, whatever the payment is, we'll split it 50-50. Should one of them pass away, well, a lot of times the insurance company will increase payments to the survivor. And so they'll get like 3/4 of what both were receiving when they were both alive. So we pay 50-50 till one of them dies, and then we increase payments to the survivor until they die. Joint life is a tricky one. Joint life is kind of like joint survivor. We're going to pay to two people. But with joint life, we pay 50-50 to two people. Whoever dies first wins. Because when the first one dies, all benefits end. So we're going to pay to two people. When one dies, all benefits end. There are no more payments paid out. The insurance company keeps the rest. So that's actually a type of payout. And some people don't like that because, wait a minute, if the other party dies, I get nothing. Yeah, but to be honest with you, joint life has a higher payout for both of them while they're still alive. Okay. So yeah, if you're thrifty, take the higher payout for married couples, right? Take the higher payout, be thrifty of it, use some of the money to buy life insurance on each other. So when one of them dies, this annuity stops paying, but now the life insurance is in place to take care of the other one. Right? Joint last survivor is a different variation. Let's say we have two people, we're going to pay one until they die, then we'll pay the survivor until they die. So we pay one at a time. Right? A very, very rare question is something called the temporary annuity certain. It's kind of the opposite of life income with period certain. A temporary annuity certain, I'm going to pay you for a short period of time, such as 10 years or until you die, whichever occurs first. So it's not, I pay you to the end of the period or until you die, whichever occurs last, which is life income with period certain. I pay you to the end of the period until you die, whichever occurs first. Okay, so if you live the 10 years, benefits end. If you die during the 10 years, benefits end right there. The insurance company keeps the rest. Okay, that would be for someone, I would say, that may have a terminal illness and they want the highest payout for that short period of time to maybe help cover their medical expenses. That would be the one because they're not expected to live past the 10 years. So just an example of how that works out. So again, I want to get back to it. How does it really work? Accumulation period, you're putting after-tax money into this account. Right? It's growing, earning interest on a tax-deferred basis. There's different types of annuities as far as your risk tolerance. If you're very conservative, we have a fixed annuity, kind of like whole life. Everything's set in stone as far as the interest growth. Indexed annuities, where the money goes into the insurance company into an account that mimics a stock market index, which like the Standard & Poor, which is the most common. Or variable annuity, where your money goes into the insurance company, into the separate account, and into the stock market. And the owner of the contract chooses the stocks, bonds, mutual funds, or other types of investments in the cash value of the annuity. Okay, so there's no guaranteed return on that one. Okay. So that's the accumulation period. Your money is growing at whichever choice whichever option you've chosen. And then remember, the annuity period is where you stop paying in, you start taking money out. It's kind of silly to kind of start taking money out and then put it back in. That's not how it works. You save money, deposit, build up a lump sum at a later date, then you take systematic withdrawals. Okay? So, and that's basically how it is. When you take the money out, since all the money was growing on a tax deferred basis, when you're taking money out, all the money that you paid in is after-tax money, so you get that money back tax-free. Right? But the gains when you take the money out will now become taxable. Hopefully in retirement you're in a lower tax bracket where you pay less in taxes on the gains when you take the money out. But by taking money in payments over a period of time, you're spreading your tax liability on the money that you're taking out. So, and we'll get into that exclusion ratio kind of near the end of this training here. So again, the periods of time, accumulation periods where you're putting money in, letting it grow. Then you annuitize, you stop paying in, you start taking money out. And then you have the annuity period where you're taking payments out for that period of time. Okay. So with a fixed annuity, like I said, your money is going into this account. It's earning a fixed interest rate. A lot of companies will give you like a guaranteed minimum interest rate with a current interest. So if interest rates go up, you get a little add-on into your the growth of the cash value. But there's always a guaranteed minimum. Right? So your money goes into the insurance company, into the general account, and the insurance company manages the investments to give you that guaranteed minimum or fixed return. With an equity indexed annuity, they're using an indexed crediting strategy. So your money's not really in the stock market. You're in an account that's kind of mimicking the growth of a stock market index. The most common is the Standard & Poor, or a lot of times you'll hear it called S&P 500. Okay? And so you get the upswing of the market through that index, I should say. Maybe there's a cap, but if the market drops or your index account drops, there's a guaranteed minimum. So there's what we call a floor and a cap in most cases, not in all. Okay. But again, in this situation, the insurance company basically chooses the investments and gives you, their clone or mimic of the S&P 500. All right. So, which is kind of good. It's kind of neat that you get the upswing indirectly to the stock market through an index with a guaranteed minimum. So, and that's how that works. And then we have variable annuities, where your money goes into the insurance company, into the separate account, and into the stock market. And like I said earlier, the owner of the contract chooses the investments in the cash value of this contract. So they pick the stocks, bonds, mutual funds, and some other investment tools, and therefore they bear the risk. So they can pick some really good investments, have really good growth in their annuity account, or they can pick some really lousy investments and have little or no money in their annuity account. Okay, so this one does bear risk. So if you can't handle risk, this is not the program for you. Now, when you buy a variable annuity, you're making payments in, and you're going to purchase what's called accumulation units. Right? So for those of you that are familiar with mutual funds, it's kind of like buying shares of a mutual fund. The price changes and the number of units that you buy or number of the shares that you buy does vary. Okay, so same thing with a variable annuity. The price of the unit changes and the number of units can change as you're buying more, or some get kind of decrease here and there. But then when you annuitize, these accumulation units will be converted to annuity units. So this is kind of tricky because when you annuitize and you have these annuity units, the number of annuity units is now going to remain constant. It doesn't change, even though you're taking payments out of this account. So you want to view an annuity unit, accumulation unit is like you're buying cups. Okay, you're buying cups, and the cost of the cup changes all the time. So if you're doing systematic payments, let's say $200 a month. The price of the cup changes. So sometimes when the price of the cup goes up, your $200 buys fewer cups. But, here and there, your $200 buys more cups because of the price of the cup has dropped. Okay. So again, the price and the number of cups changes all the time in the accumulation phase. When you annuitize, the number of cups you've accumulated now remains constant. And so let's just say you purchased 10,000 cups. And we're going to put them out in this parking lot, and we're going to fill them half full of water. And then we determine what's called an assumed interest rate. And so what's happening is you have 10,000 cups, and let's just say you want, $1,000 a quarter to supplement your retirement income. And so we calculated, if we take 1% off the top of every cup, so we kind of skim some water off the top of each cup, just 1% off each cup, that'll provide you with $1,000 that first quarter, which is what you wanted. Well, guess what? Next quarter, it's been raining. So your cups have more water in it. So if I take 1% off a cup that has more water in it, now you get a little more water to drink. Okay, so you get like $1,500 the next quarter. The next quarter, right, the water level of the cups has declined, the sun's evaporated, you've been drinking it, so there's less water in your cup. So if I take 1% off the top of each cup when there's less water in it, then you actually get less to drink. Maybe you get like $850 that next quarter. And so your payouts can actually fluctuate. Okay, so the water is like the value of your account that you're investing money in the stock market, and the cups stay the same. And so when you're taking payments, we're just taking a little bit of a skim off the top of each cup, and that's your payment. So the number of annuity units or the number of cups stays the same, even though you take money out. Hope that makes sense. You do need to understand that for the test. It's very common to have a test question. The accumulation period, you're buying more units, and the price of the units does change. But when you annuitize, you're not liquidating units. The number of units stays the same, but the value of the unit will fluctuate depending on the performance of your investments that you've chosen. Right? So your payouts can actually fluctuate. All right, so, and this is kind of what this is. I just added another screen here just to kind of help explain it. Okay, so, but we kind of went through that. You can pause it here if you want to review that a little further. But we're going to go into it. With annuities, it's just like life insurance. We have three premium factors. The mortality charge, right? Mortality for life insurance is what's the likelihood of someone dying at a certain age or sex. And we take that rate off a mortality table, convert it into a dollar and cents figure. Well, we kind of use that for annuities also. So that's kind of a given. And then there's expenses because the insurance company needs money to stay around to protect you, right? And then the interest. Now, the interest can be fixed, like a fixed annuity. Could be a little bit of, it may change if there's current interest rate fluctuations or it's in an indexed account. But in a variable annuity, there's no guarantee of interest. You can lose principal and interest and be left with no money in your variable annuity. So in a variable annuity, there's only two guarantees. Mortality, you're going to die, and expenses, it'll cost money to put this program on the books before you die. But there's no guarantee of interest in a variable annuity. So when you take money out of your annuity, the payments will be based on something called an exclusion ratio. You basically take the cost basis, which is your after-tax money that you use to buy the annuity, right? Because it's already been taxed. Anytime you see cost basis, it's money that has already been taxed. So your after-tax money is buying the annuity. And then the tax basis is money that has yet to be taxed. And so the cost basis is what you paid in divided by the expected return that you're planning on getting. So that turns into a fraction, okay? And so whatever the payout is, you take that fraction times the payout, that's going to be a return of what you paid in, which is going to be already, it's tax-free because you've already paid taxes on it. So it's kind of in the name. The exclusion ratio is a part of every payment is excluded from tax, and that's what we're calculating. So a sample exam question would be like this. Jack pays $100,000 into a non-qualified annuity. When he retires, his annuity will pay out $8,000 a year for the rest of his life. He is expected to receive a total of $400,000 over his lifetime. So how much of each payment is subject to tax? And so what you do is you calculate his cost basis, which is how much he paid in, and it gives you that. He paid $100,000 into it. And you divide that by his expected return. Well, he's expected to get $400,000 out. So 100 divided by 400, that simplifies to 1/4. That means if he's getting $8,000 a year, 1/4 of that $8,000 is excluded from tax. That means $6,000 is going to be subject to tax, and that's what you're looking for. Okay. So remember, the exclusion ratio, you're calculating how much is excluded from tax. That means the rest is taxable. So be wary of that. Right, so that's kind of how that works out. If you do get a math question, this is probably going to be similar to the one you want to get. or not that you want to get, but you may get. To be honest with you, it's actually easier than this. They typically use Jack pays 100,000 into a non-qualified annuity. He's still getting 8,000 a year out. His expected return is 200,000. So that means there's 8,000. One half of the 8,000 is return of his principal. The other half is going to be taxable. That's how you calculate that. So if you're going through my sample test questions, you'll see some of these questions, and the numbers will look familiar. So when you take the test, you'll recognize it. Okay? So with that, I usually open up if there's any questions, but this is just a webinar. I just wanted to give you some information. If you want more information and use our materials to help you study and pass the test, go to lgdconsulting.com. We do offer sample test questions, an online playbook, which is kind of like a virtual flashcard set, giving you definitions, terminology, and it's the way that you're going to see it when you take the test. So as much as you want to Google terms to get a better understanding of some of the definitions that are out there, you want to know them in the way that the test is going to present them to you, and that's what we offer. Okay, so our material is very similar to what you actually see on your test. Okay, and that's what the playbook is. There's additional recorded webinars. Here and there, I do have a couple charts on a couple items to help you understand the differences in different coverages and things like that. And we do have live webinars periodically, but if you do reach out, I get a couple of requests, I can schedule a live webinar, pretty quickly. Okay, so and I always leave room for questions and answers at the end of the webinar. So maybe with the live webinar, we hit a specific topic, but if you do have additional questions above and beyond that, I leave it open where I can jump to different screens and different material to kind of resolve that question, give you a better understanding. Okay. So thank you for watching this, and good luck in your studies.